Well, indeed, that was the social impact of property development as it's playing out. But let's take a look at the investment impact. We're joined now by Peter Churchhouse, Chairman of Portwood Capital, a property investment firm based in Hong Kong. Nice to have you with us, Peter. And this is a consistent debate we've had here on Squawk for weeks and, in fact, months about whether China property is, in fact, in a bubble. You do believe it is and think we could be in for a repeat, possibly, of what happened with the US subprime and also the overly hot UK market. I want to ask you, there's no way, though, that Chinese authorities have allowed monetary policy to run as long as Greenspan did in the US. So why could this be a repeat of, the scenes that we saw in the US?
Well, quite frankly, I'm not sure a foot massage would entice me out of my property, but you can see the tactics that are being used in China. But we are definitely in a bubble in China. We've seen property prices up in Beijing and cities like Shenzhen up over 100% in the last 12 months. Shanghai and Guangzhou, the other two tier 1 cities, up 30 to 40% in the past 12 months. So I think any bubble like that is credit induced. So China's setting itself up, in my view, for a major credit crunch a couple of years down the track. They advanced $1.3 trillion of new bank lending last year. They're on track to advance about 75% of that again this year, which is double the long-term average of credit extension. So this is a bubble that's been fueled by credit, and I'm afraid it's going to end badly a couple of years down the track here.
Peter, say you're right and this does in fact play out. One of the key risks, as you said, is what will happen to non-performing loans. I'm curious, if this does all come to bear, will non-performing loans just affect the Chinese banks, or will there be a fallout also for many of the international banks who are now invested and opened up branches in China?
I think primarily the big 4 Chinese banks are going to be the sufferers here primarily. They are the ones who've basically been at the forefront of this lending boom over the last 12 months and continue to do so. So I think they're going to be the big problem here. But again, in true Chinese fashion, I think it'll be swept under the carpet, just like in the US, Fannie Mae and Freddie Mac ended up now being wards of the state, being government-owned, government-controlled, government-backed, basically paid by the taxpayer. That's going to happen in China as well. You already saw the last wave of non-performing loans swept into these asset management companies 10 years ago in China. They are still sitting in the government books right now. In 2 or 3 years' time, they're going to do exactly the same thing. There will be all these non-performing loans that are sitting in the big banks will end up in these asset management companies and paid for by the taxpayer, just as we've seen in the UK and the US. So we transfer the private debt, if you like, onto the shoulders of the public sector. And that's exactly what's going to happen in China. They're going to take a leaf out of the US book here, I'm sure.
Yeah, it doesn't sound good. Listen, Peter, look, I mean, you've been a regular on this network for as far back as I can remember, to your Morgan days as well, and you've always been primarily a property man. Give us the real picture. We're talking here about credit-induced bubbles in assets in bricks and mortar and property, but honestly, with so little leverage in Chinese property, very few people actually take loans. How can there be leverage or credit problems?
Well, listen, we've already seen property cycles in China already. If we look back in 94 to 99, we saw property prices in Shanghai drop by 60–70% during that period. You saw a massive oversupply of real estate at that time. We're seeing exactly the same thing now. We're seeing a 30–35% vacancy rate in commercial property in Beijing right now. The vacancy rates are rising also in Shanghai, particularly in the commercial side. Now, that property is built on debt. It is not built on all equity. We saw the same thing in Dubai. We saw the same thing in Hong Kong in the 1990s. We saw the same thing in Thailand in the 1990s. We saw the same thing in the US in the late 80s. We've seen it all around the world. China is no different in that respect. When we have these building booms, it's all built on debt to a very, very large extent. And when those buildings fall empty and the owners of those properties can't service the debt, then you start to see property values fall fall, non-performing loans rise, and that ends up somewhere, ends up being rescued by the government and the public sector, and obviously ultimately ends up in the taxpayers, on the taxpayers' balance sheet.
Okay, so no doubt, of course, very high on the agenda as policymakers meet in Beijing. I'm just curious, though, more broadly, as development and growth gets pushed inland, westward from the eastern seaboard, the secondary cities, have they learned their lesson, or are we going to see a repeat of what we're seeing now and have seen in Beijing, Shanghai?
No, we're seeing a repeat performance, absolutely, exactly the same as we've seen elsewhere. The building boom is carrying on in the Tier 2 cities just as it is elsewhere. The big policy problem that China faces is that most of the municipal authorities receive up to 50, 60, 70% of their income that they use to develop infrastructure in their local municipal areas. 50 to 60% of their income comes from the real estate sector one way or the other, through land sales, through property taxes, and various fees and so on property. So there's a central government, they're caught between a rock and a hard place here. If they try and slow down the property market significantly, it means that these municipal authorities will end up in financial trouble themselves. So they're really struggling here. But I have to say, I'm heartened by the central policy wonks, if you like. They see this problem coming, they see it happening, and I'm encouraged that I think they will take action to slow it down.
Okay, we will be watching. Peter, always a pleasure talking to you, sir. Thank you for the time. Peter Churchhouse, chairman of Portwood Capital, a property investment company from our studios live up in Hong Kong. And a quick program.